Hello, this is Jeremy Levy, and I am a partner with the law firm Troutman Pepper. I'm joined today by my fellow partner in the private equity practice, Alec Watson, out of our Charlotte office. Alec recently moderated the Opportunities and Optimism M&A Deal Trends panel at the ACG Atlanta M&A South Conference in February 2022. He's joining us today to discuss some of the key points that came out of the panel. Welcome, Alec.
Hey, Jeremy. Nice to be with you. Thanks for doing this.
Absolutely. Thank you for joining. So before we get into the panel discussion, how did it feel to be at a conference in person again?
It was actually pretty energizing. I feel like everybody was sort of refreshed, right? You do these and they kind of seem like old hat and you're going through the motions. And so I think everybody was, pretty appreciative of the opportunity to be there. There's a lot of energy in the room. Again, people were fired up and glad to be in that setting. I think it was mostly, it was relatively new for everyone. I don't think there's been, I've been to one conference recently and I know I've heard a little bit about some others, but there just hasn't been that much of this. So I think everybody really did appreciate the opportunity to be able to get together again.
I know that people are happy to get back to board meetings in person and shaking hands and trying to live again in society. So it's nice. So your panel was about 2022 M&A deal trends. Who was on the panel with you?
We had a really good panel. It was Gary Denning from Balmoral Advisors, Linnea Geist from PDI, Cardell McKinstry from Aprio, Mike Rost from PNC River Arch Capital, and Phil Theodore from McGriff. So we had an investment banker, a strategic, a private equity sponsor, an accountant, and a rep and warranty insurance broker. And so that it really did offer a nice diverse perspective in terms of the M&A market.
Before we talk about 2022, let's step back and take a couple of minutes to review 2021. Give us your take on what kinds of trends we were seeing at the end of last year in the market.
I think pretty consistently, right? It's an ultra competitive market. Sellers were still king, right? You still felt like a good asset could easily be sold, a moderately good asset could be easily sold, and even the garbage was getting some pretty good traction. I think one of the key things that we did talk about was, as a buyer, right, what do you do to distinguish yourself in that market? It's difficult. There's a lot of capital there. Everybody's out there hunting for the same trophy at the end of the day. It's really tough as a buyer. What do you do? One thing that we heard consistently from the folks on the panel and is really similar to the experience that we've had in terms of talking to some of our clients was that buyers were really being more selective. Like the days of you see an NDA, a teaser, you like it, you sign the NDA and you really spend meaningful time on it. In a market like this, you really just can't do that because you can't sort of dip your toe in the water and expect to be competitive in these processes, right? You've got to really jump in. You've got to spend meaningful resources in terms of third-party cost. You've got to spend a lot of time, from the buyer's perspective. You can't just say, well, let me take a look at this one and that one. It's like buyers are getting a little more selective just because they have to, right? And the cost of participating in the process is increasing. And, I think we've really seen a good bit of that. That was one thing that I think resonated a lot from all sides at our panel.
And at the same time, at the end of last year, it was really difficult for our private equity fund clients to find service providers, third-party advisors, consultants, and things like that who had the bandwidth to help on deals. So it was a challenge on both ends. So what kind of timelines were you seeing in the market at the end of last year?
Fast and faster. I think it was certainly 30 days or less on anything competitive, sort of start to finish. That doesn't mean things don't actually drag out longer when issues come up. You certainly couldn't go into a process and say you can get a deal done in 45 days and have any chance, right? Everything is moving quickly. There's really a significant increase we've seen in terms of the sort of pre-baked diligence on the sell side. So, sell-side QOVs are standard, and have been standard for some time, I think. But, seeing more in terms of IT diligence, people having IT consultants come in and perform a diligence report at the outset, cyber, data privacy reports, things like that, where, anything that a seller can do to basically check that box and convince the buyer, hey, you're in a good place, move forward with this quickly, take one of those variables off the table. We continue to see a lot of that, and I think that's something that we'll expect to see more of going forward.
That's consistent with my experience and what others in our group were seeing as well. My clients didn't submit any bids at the end of last year that promised more than 10 days to signing or closing. So it was a pretty frothy market at the end, and everyone was sprinting to the finish. But let's pivot to rep and warranty insurance now. You had that on your panel as well. As you know, insurers were completely overloaded at the end of last year. That changed both pricing and terms that we were seeing in the market for rep and warranty insurance. What are your thoughts on what we've been seeing and will see for 22?
It was extremely difficult, right, as you mentioned, to even get rep and warranty insurance at the end of last year. The market was so crazy that it just ended up in a situation where like they could charge what they wanted to charge, and you really saw the insurers basically picking and choosing, right? They got to pick which deals they thought were the ones that they wanted, where they could charge the most premium, that could be the most profitable. And that left a lot of folks out, whether it was a timing issue, and you mentioned sort of vendor availability issues that were prevalent across the market, but it certainly let them price it the way they wanted to price it. Question as to whether was it underpriced before. You hear people talk about claim histories and maybe more claims are being made, and so maybe the pricing tends to trend up. It was interesting because I think one of the things that I know Jeremy, you and I have talked about, and others in our group have talked about, is sort of what happens going forward, right? Once we're out of Q4 of last year and things are sort of stabilized a little bit. I hate to use the word normal in today's times, but what does that mean from a pricing perspective? And the panelists were pretty consensus in terms of their idea that prices may go down, but they're not going to go down meaningfully. Once the insurers have figured out we can charge this and there's still a market for it, that it may be a dip, but it's certainly not going to be back to what you would have seen 12, 18, 24 months ago. So I think that's kind of is what it is, and we'll see how the market plays out. One thing that we've seen more of, and really seen it a bit over the past couple of years, but certainly saw more of it last year, was especially financial sponsors deciding to effectively self-insure. Certainly talked to some of them who said, look, we keep paying these premiums and it's a lot of money, and it certainly exacerbates as the premium gets more expensive. But we pay these premiums and we're still not making claims on the policy because you've got to do a ton of diligence to make this work. In this situation, you're going to be digging deep. You're probably buying from a financial sponsor who's already done the same thing on their end. And so, in that situation, do you not just step back and say, look, we're going to basically take what we would have spent on the premium and essentially view that as our own backstop, and we'll deal with that to handle the claims. And if the claims don't come up because we did such a good job of diligencing it and we bought a clean asset, then that's even better. I wouldn't be surprised to see that. I don't know that that's the risk profile of every sponsor. I think that some of them certainly sleep better at night having that policy in place and have gotten used to it. But it'd be interesting to see as this year develops whether you see more of that happening in the market.
Yeah, I wonder if that arose more from the expedited timelines than it did from the pricing. I mean, I had conversations with clients of mine in the same vein, and we're talking about the pros and cons of RWI, especially given that historically there haven't been tons and tons of indemnity claims. Now you're coming out of pocket in order to pay for the premiums. There have been a lot of discussions about the value proposition. But in my experience, and I'm curious if yours has been the same, before the sort of frenzy of the end of last year, the value proposition was worth considering, but we sort of more frequently saw our clients actually going ahead and pulling the trigger on the policy. Whereas towards the end of last year, my clients, at least who chose to self-insure, did so for a combination of the reasons of the value perspective, but also the time, like you said, the ability to skip diligence effectively, or at least do it on a much more streamlined basis and not have to show your work to your insurer. That really helped my clients out on that decision. Are you seeing similar types of decision making?
I think that'll be interesting to see. We did have one client who literally went back and sort of looked at their claim history and deal history over several years and just modeled it out and said, here's how much we've been spending on premiums. And in this entire time, we've made no claims on policies, and we've made sort of one or two claims, I think it was, under sort of general, sort of the old school rep and warranty, the old school indemnification package. They look at that and just said, this just doesn't make any sense. Now, they may regret those words if you end up in the sort of worst case scenario down the line, but I think you're right. I think it probably is a combination of both of those.
So I started the podcast asking what it was like going to a big conference in person again in light of COVID. Let's talk about COVID and its continuing impact on deals in 22. How has COVID affected sponsors and where do we think we're headed?
I think a lot of folks actually talked about some of the good things that have come out of it. The fact that basically a lot of this travel that everybody did from in terms of your bankers and sponsors and so forth, it's just not necessary, right? I mean, I think a lot of folks realize now that the video conferencing just wasn't utilized to the way that it could have been, and that we actually can get a lot done the same way. Is it a perfect replacement for being in the same room with somebody? No. And I think everybody on our panel and most folks I've spoken with, and would expect you're in the same place, they weren't doing deals without seeing somebody. Like they would be in the room, almost invariably, be in the room at some point with somebody. It may be certainly a fewer number of times than you would have in a pre-COVID environment, but you are going to expect to have that in-person communication. But it does save them from a lot of diligence meetings that probably didn't have to take place. Most of the diligence that you do can be done on a remote basis, and this sort of gave everybody an excuse to re-examine that and kind of sort of revisit exactly how that process should play out on a more efficient basis. The one thing that really resonated with the folks we talked to was the biggest disadvantages weren't so much related to the process themselves, but were more so related to integration post-closing, right? And the fact that you've got this new asset, you've got these new employees, they have not, at that point, will not have met in person with the sponsor as much as they would have otherwise, as relationships may not be as extensive, and then just sort of throughout the general employee base, right? Trying to integrate people in an environment where you really can't get in front of them. Those seem to be the kind of biggest challenges that people were facing and trying to adjust to. But by and large, I think everybody's kind of gotten used to it at this point.
In my experience, I'm really seeing that play out. If you compare the relationship, the personal relationship that my sponsor clients have with their portfolio company CEOs, as you contrast a company that was purchased prior to COVID with the old-fashioned diligence process, lots of management meetings, lots of hand-holding prior to acquisition. Contrast that with the relationship that the sponsors have with their portfolio company CEOs who they bought during, or the companies that they bought during COVID. I experienced board meetings where there's a noticeable difference between the relationship. That is sort of playing itself out as we become more accustomed to this new normal. It's interesting. It'll be interesting to see how that plays out both in the operational period and also on exit. So let's look at some macroeconomic issues that are commensurate with COVID. Are the labor shortage and supply chain issues we're seeing in the global economy going to impact deal making this year?
Yeah, I think it certainly continues to impact things on the deal side. I think you see it more frequently in some industries than others, like, for example, hospitality, manufacturing. I think it's very prevalent in those. Generally speaking, I think that the vendor shortage on the deal side, right? I mean, that I think was more temporary and probably not something that we'll see on an ongoing basis, maybe peaks and valleys, obviously, when that stuff does come up. But it's hard not to think that that doesn't have some impact, generally speaking, on deal making as we move forward.
You mentioned it. The elephant in the room in 21 was pending tax reform. Now that we're in calendar 22, the calendar year flipped, are you finding sellers still focused on the pending tax law change, or has that lessened?
I think there's still a focus there. We're talking about dealing with our federal government, right? And so nothing happens quickly, nothing happens efficiently. For the last 2 years, it's been a big driver of year-end deal flow. Will that happen again? I guess it depends on what happens during the year. One thing we certainly are seeing is that given the high valuations, one way to combat that, right, is through the use of things like earnouts and seller financings. Those become more difficult, certainly, environment where you're expecting tax rates to increase, obviously. I think whether that sort of mitigates the use of some of those tools going forward, we may see more of that. But I think everybody's still, we've all heard predictions, and we all continue to wait and see how it's going to play out.
How about inflation and rising interest rates? What impact do you see that having?
The consensus that we hear is that look, interest rates are at such a historically low place right now that it's relative, right? So a rising interest rate environment from the perspective of how you finance your deal, right? The mix between debt and equity. Debt's still significantly cheaper than equity is. So while you would like to pay lower rates, it's not, I don't think anybody expects, interest rates to become so prohibitively expensive that it materially impacts the availability of debt financing. Does it change the mix between debt and equity? Maybe. I think the bigger issue would be if the rising interest rates lead to a broader economic slowdown that just sort of puts a damper on the market generally. If that happens, then I think that's where you'll see the bigger impact rather than just sort of the moderate increase in the cost of capital on the debt side.
We'll have to see how that plays out over the course of the year. There are obviously lots of commentators predicting that slowdown. So we'll see what happens. Fingers crossed. Alec, that's all the questions I have for you today. Thank you for your time and discussing your panel at ACG South. It's been a great discussion.
Thanks, Jeremy. Enjoy catching up.
Absolutely. I also wanted to thank our listeners, and I hope you found our conversation insightful as we continue further into 2022. Consistently recognized as a top-tier national practice, Troutman Pepper's corporate attorneys regularly handle multi-million and multi-billion-dollar transactions, and the firm has particular expertise in the private equity and private fund services spaces. We advise clients on matters from fund formation to acquisitions, investments, and exit transactions. For more information about Troutman Pepper and our private equity group in particular, and for the latest insights from our attorneys, please visit www.troutman.com.
Copyright Troutman Pepper Hamilton Sanders, LLP. These recorded materials are designed for educational purposes only. This podcast is not legal advice and does not create an attorney-client relationship. The views and opinions expressed in this podcast are solely those of the individual participants. Troutman Pepper does not make any representations or warranties, express or implied, regarding the contents of this podcast. Information on previous case results does not guarantee a similar future result. Users of this podcast may save and use the podcast only for personal or other non-commercial educational purposes. No other use, including, without limitation, reproduction, retransmission, or editing of this podcast may be made without the prior written permission of Troutman Pepper. If you have any questions, please contact us at troutman.com.